Hello and welcome to today's episode. Today I'm with Lior Gantz, who is the editor of Wealth Research Group. Lior describes himself as a deep value investor, researching businesses, trends, and assets that are off the radar and either forgotten, unloved, or unknown to most investors. Every time I either talk or listen to Lior, I learn something new, as he always has a very unique perspective, one that will challenge traditional ways of thinking. Hello again, Lior, and welcome to Ready, Set, Crypto. Where are you calling in from today?
Hey, I'm in Park City, Utah right now.
Park City,
Thanks
Utah. Every time I talk to you, you are at somewhere else. You're the what's the term for that? Not a vagabond, but a digital nomad, I guess is what I'm looking for. So you kind of exemplify the digital nomad life.
Yeah, I am with my wife and daughter, so definitely it's a family nomad.
Oh, that's great. So what are you seeing in crypto right now? What's here we are, it's early February of 2019. We've made it through the bear market so far. What are you seeing as the hot buttons right now for this industry, and what are you expecting for 2019?
Well, first of all, I think what happened in 2017 was a unforgettable year, but it's going to be a rare year. So the level of fascination, the level of anticipation and speculation was really unreserved. You have companies that or ICOs or coins, it doesn't matter, that had very little to offer in ways of real assets, but they had an idea, and those ideas were really valued to a point that they were unsustainable, and therefore other bidders that came in after the existing ones took prices up too far, just didn't allow themselves to get carried with this, and so it just reached a point where buyers just do not want to pay anymore. But once that happens, obviously it's a top for every market. It can be an orderly top, or it can be really a blow-off top. And what happened with Bitcoin as the prime example was a blow-off top. You just saw it crashing, and then settling at some point where people with less of a speculative angle and more of a longer-term position, thinking, hey, this is just a project that I want to get involved with over the long term. I think that this is a great price to enter. I've came in, and let me caveat this. Bitcoin started trading for 1 cent, which was too low. So it started undervalued, tremendously undervalued, and therefore going all the way up to whatever you believe is the intrinsic value. That sort of transition that happened for the very early entrepreneurs, the very early founders. In the traditional world, if you look at, for example, a company that everybody knows today like Johnson & Johnson, back 150 years ago, nobody knew about it except Johnson & Johnson and the founders of the company, some bankers that were involved, and a tightly knit group of investors. And that's the same as Bitcoin. So that phase is over, that foundation phase. And now it's a whole new era, and the speculative appetite is not there. What is there is the same as what we saw with the dotcom companies after 2000, where you just look at the companies and say, okay, well, this company has something to offer. This doesn't. The internet itself, which is equivalent to like a blockchain, is a great industry. So that's what investors in the 2000s they thought. The internet is going to be here. Here are applications that can happen on the internet. We can have online sale, e-commerce, etc. There's many applications on the internet. There's many things to do on the blockchain. Not all 1,600, 1,700, 1,800 companies that have raised capital can, actually perform on the idea that they want to do, have the capital necessary to do it, have the marketing power to do it, be competitive to do it and not get competed by other entrepreneurs, and have the wherewithal and the resources, the resourcefulness, the imagination to do it. So we just had too many companies or too many projects, and therefore too many failures all at once.
You know, I hate to keep bringing up the dot-com bubble, but there's such an analog to this. I mean, I personally went through the dot-com bubble. I joined a startup company in the late 90s, and we went through the same exact thing, is that we were not able to create something fast enough. And, you know, back then you could get funding on a whim, on an idea. It didn't have to be anything. A cool domain name would get you funding. And we had to go through a bubble back then. And the same exact thing seemed to happen. So it seems like in today's environment, it just seems like every asset class has to go through, we have to continue going through these bubbles. Bubbles pop, and then eventually on the other side of the bubble, real value is created.
Yeah, I'll let you know. I was 13 in 1997, and I was babysitting this teenager. I'm sorry, I was a teenager, and I was babysitting this 6-year-old. And what happened is this is like the dot-com era, and I come to this person's house. This is 1999, if I'm not mistaken by now, and the guy is in his underwear. Just sitting in the afternoon, never home. I've never seen the father. It's always the mother. And the father is home. He's got his underwear on. You know, these Speedo types, like, I don't care who's coming into the house, whatever. And he's looking at CNN on the huge projector. Now, this is 1999, so those projectors used to cost like 4 times rents. So this is rare. There were like 20 of these in the country. And he's saying, Leo, look, we just sold a company. And now I don't know he owns the company. So I'm looking at the screen. I'm only 15, right? I don't know too much about business. And he says, no, it's $4.5 billion. We sold to Lucent Technologies, which was like a $200 billion companies back. And they had an idea of how to have more bandwidth inside of the optic fiber or whatever. Just an idea at that point. 2 founders, he and another person, took $700 million each. So I was like present seeing the how that happened, because like 2 months later, that position, because this was in Lucent shares that they got the millions in, it was worth half of it. Not that we underestimate 350 mil, but
well, that probably made an impression upon you when you were that young.
I actually like 2 or 3 months later, I got with my banker as I celebrated my 16th. And he says to me, if you want to start investing as a minor, you'll need to have consent from your parents, like a waiver, and start investing. And that was June of 2000 when I actually started investing as a minor in publicly traded companies, 3 months after the bubble burst. So it did inspire that initial step. And my grandfather was, I told him about this. He gave me 2 books, one from Warren Buffett, the other one from Peter Lynch. And Peter Lynch was actually one of the best performing fund manager of the 80s, from 1997 to 1990. His fund that he managed that had thousands of stocks in it. So this guy was a genius, able to manage a portfolio with about 2,000-3,000 stocks, something we don't see today at all. That fund generated 29.7% a year. Just to give people a perspective on this, the S&P 500 does about 7.5%, so that's 4 times the S&P 500, which means in today's world, every client, every institution, every pension fund, everyone will be at that door knocking to that kind of fund. Anyways, Peter Lynch retired in 1990 and at the top of his career, and released 2 books. And in one of them, my grandfather gave me, it was all about how his teenage daughter picked some of his biggest winners, like Dunkin' Donuts. And so he always talks about, if you can't understand the company in 30 seconds, it's not the company for you. Don't get involved in stuff that's too hard to understand the business model and why it's going to be competitive.
Yeah, I'm one of the big believers that really investing principles don't change over time. Not really. I mean, there's a book that's out there called The Richest Man in Babylon, which you may have heard of before, which has got the same principles that work today that work. So, I mean, to your point, you're picking out a couple of books that are 30, 40 years old, but the principles don't change regardless of the asset class. So even though crypto is new and everything like that, it's the same thing. A lot of it's about risk management too.
Yeah. and for me as a teenager, it gave me the confidence. This is okay. What do I know about
Right.
what are the industries that I'm aware of? And at the time, I was also working in like a store salesman for clothing, so I knew brands, and that was when I picked up my first stock. Now, the Buffett book talked about the power of brands. So those two married the marriage of those two books was a teenager can focus on companies that he understands, and find a brand name, which is a long-term investment if you can find it for cheap. Now that burst of the dot-com bubble offered up a cheap apparel manufacturer, and actually bought those shares back then, and I owned them up until a few months ago for about 18 years. The company went up about 1,600% on the appreciation, and the dividend went up 700%. So it's like a very successful investment. It's the number one apparel manufacturer in the world, but
Wow.
many people don't know about it. It's a holding company. The brands are very known, but the parent company isn't as much. But anyways, to put a long story short, the dot-com era very akin to what's happening right now, and all we need to do is find those victims that have unjustly become too undervalued as much as they were too overvalued in 2017. So that's where I'm at. I'm very optimistic that some of the crypto projects will be the leaders of this blockchain revolution, which is undergoing and in place. There's nothing that has changed to make blockchain irrelevant. It's not like
Are
something
there
came along.
are there a couple of well-known projects that you still believe in?
I think for Bitcoin itself is a project that has characteristics that are not company oriented. The fact that it doesn't have a management team, the fact that it is really the decentralized coin, will always give it, in my book, additional preferences and competitive advantages that other coins cannot give. And I think that still retains the number one priority with me. So I think that is something that is key. And a second project, which I'm looking at currently, I will be publishing like in-depth information on it. I don't want to, tell you in advance about it just because I'm not ready to share all the details yet. But in the newsletter, in our free newsletter in Wealth Research Group, we will feature this company probably within the next 2-3 weeks here. It's a very undervalued company and unknown, like under the radar as it comes when it comes to these sort of projects. And the beauty about it, it's a publicly traded company. So unlike crypto projects that have a limited amount of people that can trade them for now through the brokerage accounts that exist for crypto projects, this is a traditional company. So traditional investors, which are obviously much more in volume, can get involved. So I like that angle as well, of looking for publicly traded companies that are involved in the blockchain sector.
Lior, what do you think is going to happen when some of these, I guess we call them traditional brokerage companies, such as Fidelity, Bakkt, Goldman Sachs, et cetera, there's others that are rumored to also be in the space,
Yeah.
and they're going to be bringing millions of customers on board.
Sure.
Do you think that there's going to be any chance that those people are going to find a way to get into crypto, or does it require some type of custody solution, or maybe futures, or what is it going to take to get those trillions of dollars of investing capital into crypto?
Well, I think the most important thing is what you just said. These institutions, Bakkt especially, is going to be a custodian service. So the reason that funds cannot enter the crypto space right now for their clients is because they must invest through a custodian service. When hedge funds buy stocks, McDonald's, Starbucks, etc., they do it through a custodian service. They must have somebody that is actually in custodial service of their ownership. Even you and I, when we invest, there's a custodian service involved, even though it's in the background and we don't know about it. With cryptocurrencies, you own the keys, so there is no custodian service, and therefore institutional investors could get into the crypto space thus far. That's why there's only 35 million people that in the U.S. that have owned Bitcoin or a cryptocurrency at some point, and if Fidelity, which is the largest asset manager in terms of their brokerage services, and this new company Buck that is actually owned by the owner of the New York Stock Exchange, and it's the largest exchange operator in the world, with some very reputable seed investors like Microsoft, Starbucks is in there, etc. If it was delayed from the 24th of January to an unknown date, but these things move along pretty fast, especially when there's so many lawyers involved at the highest level. Then Goldman Sachs, I don't need to tell you, it's a powerhouse bank.
That's the evil empire.
For good or bad. But
yeah.
At the end of the day, they collectively can add about a 12-fold increase in customers to Bitcoin now, and the cryptocurrencies in general. Now, just imagine the cryptocurrency industry is akin to like a garden hose, and if you add these three mega houses together, that's like pushing a basketball into a garden hose. At some point, that garden hose it has to absorb that size of basketball, and for it to do that, the price has to come up. There is no way to bid up the price of Bitcoin with a 12-fold increase in potential customers, and for the price to remain the same. So that part of adding these custodian services, this is probably going to be a very positive effect for the price of Bitcoin and for the price of other coins. Now, I remember
it's interesting you say that. I'm sorry to interrupt, but because I see a lot of chatter around Twitter, around just about any discussion group, that there's an association with either whales or institutions as being on the other side of the retail trader pushing the price down. I personally disagree, because I think an institution is going to go to where they think the value is. And if it is to the downside, it could be to the downside, but I think the easy money's already been made at that point. So it could very well be to the upside.
Well, so Fidelity makes money through charging commissions. Same Bucks will do the same, and Goldman Sachs will do the same as well. There is no incentive for them to see the price going down, because obviously that creates panic and less commissions for them. Could they be orchestrating some sort of a price reduction in advance of their entering the space? Who knows? We don't know who owns Bitcoin and etc. We can follow some of the big wallets, etc. But regardless if they're doing it or not, and we have no evidence of it, it's really it doesn't matter in the long term.
Well, every bank is going to have their own trading desk, and every bank is going to go where they see the flow of the money going to. So wherever that is, but I don't think it's kind of interesting, because we've sort of had this almost in the retail space, in the traditional stocks or options, derivatives, anything like that. There's always been this sort of loose correlation between the institutional money, the big trading desks, and the retail traders. And the retail traders know that to make money, you can't go against those guys. And so they've learned to coexist in that space. And we haven't quite gotten there yet in crypto. And I think that's something that'll happen down the road.
Yeah, sure. Crypto is a very small industry overall. If you measure
right,
stocks and bonds are about $30 trillion
right,
industry, and Bitcoin is like $60 billion. So it's peanuts compared to the big money, and we shall just wait and see. The ideas behind this, and the ideas behind tokenization, which is one of the biggest trends right now, is very viable and very interesting for companies to be taken a part of. If a company like Walmart, for example, issues their own coin, it gives them a lot of predictability as to their cash flow, because they know the size of their economy. They know how much to expect in revenue. They can market to your cell phone and say, hey, if you spend 2 coins today, we'll give you a third coin or something like that. So the tokenization is far better than a loyalty card, which is it's in fiat currency. This is in their own currency. It's just the most important aspect of their business, because it gives them a lot of predictability as to future cash flows. They know how much money how much purchasing power is out there in any community, any city. So I really think that tokenization is like a big next step, and that's going to drive a lot of the price action, and we shall see how Bitcoin definitely takes part in all of in this revolution. So in general, I love how Bitcoin went down 85%, 85 to 90%, very similar to other bear markets. It's just that it went from 20,000 to 3,000.
Right.
That is huge, but it also went from $32 to $2. So in percentage, it was the same. It's just that there were like 5,000-6,000 people that cared about it at that point,
Yeah.
and now it was a huge event. So I don't see any problem with that. I don't think it stained the progress behind the scenes. It didn't drive away developers, and it didn't drive away traffic. In 2018, there's been an increase of 100% in terms of users. And here's the big thing. In a recent survey, 2/3 of the surveys, or whatever you call them, the people surveyed, they said positively that if a financial advisor told them to invest in cryptocurrencies, they would. So definitely the appetite and the idea behind this is very strong.
Absolutely. Yeah, and I agree with you on the tokenization too. I think that is going to be the next big wave. That's something that we're definitely trying to be at the tip of the spear on. I mean, your imagination can run wild in terms of the applications for tokenization here. So this is like what ICOs should have been and what they can be. That's that. One last thing I wanted to bring up to you, because you're sort of an expert in terms of using gold as sort of like an inflation hedge, or, in case the governments go crazy with the fiat currency and just print it to death. How do you see physical gold versus Bitcoin in terms of perhaps a currency hedge or sort of a survivability hedge going forward?
Yeah, I some of the attributes that gold has, Bitcoin has as well, and so that aspect of being outside of any political system and holding a currency, a medium of exchange, is similar with gold, silver, and with Bitcoin. The size of the economy for gold is much larger and much more liquid because there are more participants, and it's been around for thousands of years. So that aspect of it, for institutions and governments and central banks, is more appealing to them right now than Bitcoin is. But in general, the main difference between gold and Bitcoin is the fact that gold is a mineral, is an atom out of the earth, and has these attributes that give them durability over thousands of years. If you sunken ship and that gold is in there, it retained its value no matter if it was in the abyss, which is not something you can say about many things, right? It has these very unique attributes that societies simply decided were valuable, and they tried many other things, right? Rice was tried as a currency. It expires, a few days later. It's exposed to the environment. They tried, stones and shells and salt and silk and whatever else commodities, tea. They tried many things, and gold and silver just seem to have the best attributes to be called money. In the 20th century, this has been changed radically to where now our currencies are basically just floating compared with each other, but they have no redeemable quality. So you can't go and redeem them for anything fixed. You can redeem them for gold. You can buy gold, but the price will change every time. So that fixed ability that they lost has allowed governments to simply create more of them, more currency units, and drive themselves into a debt, an unsustainable debt mountain. And the only reason it keeps on going in an orderly fashion, quote unquote, is because it's legal tender, so it's everyone's bound to use it. But otherwise, if you told every person in the world, hey, look, this piece of paper is simply a piece of paper, and there's no difference between the 50 and the 100. It's that written, it's 50, that is written 100. I could print those kinds of things, and force everyone else to use them. So
it's actually interesting. Most people don't actually look at what's printed on a dollar bill or any of the currency. Back with the full faith of the U.S. Treasury, this is a Federal Reserve note. So it's a dollar is a Federal Reserve note. So basically they can print those at will.
Yeah, well, they need to have some sort of accountability so this project that they're on doesn't go south. But yeah, they can print using measures that you and I would find ridiculous, and obviously they are ridiculous because we see what happens when they go bad. So that aspect of it, putting your money, your savings in gold, silver, or in Bitcoin to hedge, I don't know if against inflation as much as just against the problems that can happen in any economy, and they can lead into inflation. So the U.S. economy can go into a recession, and the response from the federal government and from the central bank will dissatisfy the citizenry, that they
very well could be seizure. There could be a wealth tax.
Exactly.
We're already seeing politicians make noise about instituting a wealth tax, and that's even before the problems come along. And so it's interesting if you can get an asset that cannot be seized.
Exactly.
So
it cannot be seized, cannot be confiscated, very secretive, very private. And then with Bitcoin, what's beautiful about it, obviously, is it's very storable. If you need space for gold and you don't need space for Bitcoin. So that's what I think is important. This is where Bitcoin has the advantage, right? It's not a physical atom, so you can store it.
It's portable.
You can put it here.
Yeah.
If you're willing to risk it.
Tattoo it on your forearm.
Yeah. Yeah.
Well, excellent.
So I think that's important.
Very, very good. Well, thank you for coming by today, Lior. It's always been fascinating to hear your perspectives on things. How can people learn a little bit more about what you do and some of the services that you offer at Wealth Research Group? So
I think the two best ways, either hit the website, go to the special reports button at the top, and you'll open up a great wealth library of download reports that you can have just a beautiful weekend reading and a lot of education. It's everything we've ever put out in PDF form, just a bank of downloads. But if you want the most current and up-to-date, everything that I share from transferring from my brain to the subscriber, just go to the website and become a subscriber to the free newsletter. That's what most people do.
And what website is that again?
wealthresearchgroup.com.
Okay, fantastic. Lior, thanks again for coming. Again, my guest here today was Lior Gantz of Wealth Research Group. And that is it for this edition of Ready, Set, Crypto. So thanks, everybody, and we'll see you in the next edition.
Thanks, sir.